Thanks for tuning in here to our September Cutting Through the Noise Investment Webcast. I'm Tony Welch, Chief Investment Officer at Signature FD. Now, I'm going to start today off with actually a little bit of a celebration because with today's webcast, we've now been doing this webcast for clients for 3 years, right on the nose. And I want to thank our clients for the great questions that we've gotten, the feedback along the way. And for this month, for this month's version, it's clear that markets have quite obviously been volatile all year long with huge swings, and the volatility's tended to pick up, especially around these inflation announcement days like we had on Tuesday. It can be pretty difficult to wade through all of that volatility and focus on the indicators. But that's what we're going to try to do today, just as we've done in each of the past 36 of these webcasts or so. And I wanted to start today with a bit of a statistic, is that we've been doing these now for the last 3 years, and it's been inclusive of the COVID crash and now this Russian and Ukrainian war and inflation and Fed-driven bear market. And you might not believe this, but over the last 3 years, despite these events, stocks are up at about a 10% annualized rate, even through all of this. And the point that I wanted to make in that statistic is that returns are volatile. Markets are exceedingly lumpy, especially in the near term, but long-term investors have historically been rewarded. So what we're going to focus on today is 3 things. Like, we kind of normally have about 3 topics that we want to dive into. And the first is on midterm election year trends. Now, we've been talking about this ever since our Outlook piece at the beginning of the year that we wrote. We discussed it in our webcast back in early January, is that midterm years tend to be the most difficult in a 4-year presidential cycle for markets. And though the magnitude has been a bit more this year, the pattern's been remarkably similar to prior midterm years. So we'll discuss some of those implications. Now, certain measures of inflation, particularly gas prices, have slowed down or even improved pretty substantially in the last few updates. And we've seen a tentative positive response from the consumer. And we're going to talk about the economic implications around that. And finally, most of the recent questions that we've been getting have really been around these geopolitical risks. And we're going to spend some time talking about why we would want to even bother with international investing at all. So let's first start with the midterm election year trends in general. This chart here shows the average pattern in midterm election years for stocks in dark blue. The lighter blue line shows what's happened so far this year. Now, we can see here that September has been notoriously a difficult month for stocks before giving way to a Q4 rally on average. So the volatility that we've seen thus far in the month is really nothing new. Now, this chart here breaks down returns by quarter for the average presidential cycle, and those are the blue bars in the chart. And also, we're showing the current cycle, which are the red bars. Now, directionally, the pattern for these first 2 years has played out very similar to historical patterns, even though the magnitude's been much greater. Now, we would chalk up that greater magnitude to the extremes that we've seen in fiscal and monetary stimulus in 2021, and now this massive tightening in those conditions in 2022. Now, historically, just getting to the midterm election itself has been a pretty decent catalyst for a rally. Actually, starting about a month prior to that midterm election, that's when the market's really begun to build out a year-end rally. Now, we've spent a little time here to start on the historic cycle analysis. And to be clear, past cycles are not the primary driver of our investment decisions. But the presidential cycle has been very consistent for a really good reason. It's tended to track with a well-defined monetary and fiscal policy cycle. So what we're showing in this chart in blue is that same stock market cycle, but in orange, we're showing the pattern of monetary and fiscal stimulus. Now note that in midterm years, stimulus has tended to be a huge drag. But then as we get through the midterm, stimulus begins to reverse and becomes more of a positive driver. And that's true for the market and the economy up through the next presidential election. Now, I think the focus so far has really seemingly been on the Fed, squarely on the Fed. But I'm not sure it's very well understood just how much of a drag we're getting on the fiscal side this year. Now, this chart is showing the federal budget deficit in red. Note how it skyrocketed starting with COVID, but that's been rapidly unwound. And the fact that we're not already in some sort of devastating recession is a testament to the underlying strength of the economy we had heading into 2022. For context, and the reason I say that is this budget deficit reduction of 2022, that is the largest budget deficit reduction since the post-World War II years. No other time period in modern US history comes close to this sort of fiscal budget reduction. Now, we'd argue that this trend is imperative in getting inflation down, but it certainly created a major headwind for stocks and bonds in 2022. Now, we're not likely to see this sort of deficit reduction in 2023, which would remove a major headwind for markets. Now, I think that there is a big fear following Tuesday's inflation print that the Fed will be exceedingly tight in 2023. But we still believe that a lot of the heavy lifting that the Fed is going to get to where they need to be on interest rates, we think that'll be done by the end of the year. So let's talk about the potential outcome come November. Now, full disclaimer, this is not our view or representative of any of our own personal political views. It's just a pure look at pure survey data, and we can make some observations. First, gas prices have fallen for 13 straight weeks. What we're plotting here is weekly gas prices in blue, and in red, we're showing the inverted reading of a generic Democrat on the ballot. So when the red line is rising, that would mean that the Democrat lead is falling or even going negative. When that red line is falling, that means that Democrats are gaining ground on a standard ballot. Now, this measure has tracked gas prices with remarkable consistency. Just a few months ago, it looked like there was really a red wave forming, but recent special elections and this turn in polling suggests that the races will probably be pretty tightly contested in November. Now, as we get closer to the election, we can start to narrow out those potential outcomes. Now, this chart here on the bottom is showing the current betting odds for the different congressional mixes. Note that the two most likely outcomes are that the Republicans either take the House and the Democrats retain the Senate, or that there's a Republican sweep. Actually, this chart is slightly out of date. With Tuesday's inflation print, that saw a small shift toward this second scenario away from the first scenario, which would be a Republican House and Senate. Now, note what's impactful to that for markets is that the two most likely outcomes of the midterm elections have historically coincided with very strong market performance. The takeaway here is that the market has historically appreciated gridlock. Now, we are big believers that no two cycles are exactly alike. One can cherry pick similarities at all times, but when you really dig in, you're likely to find very large differences as well. It's our belief that this economy is just far too dynamic to serve as the same dish twice. But let's assume that this is, in fact, a carbon copy of the 1970s. We still suspect that inflation is going to continue to make improvements from here. Here in this chart in blue, we're plotting the rate of inflation historically. In red, we're plotting an extremely robust model of inflation pressure developed by our friends at Ned Davis Research. This includes 22 different inputs to identify peaks and troughs in inflation. Note that this model gave us a peak inflation signal back in July. And also note that in the 1970s, the peak inflation signals were also very accurate. Now, there were some aspects of the August report that we got on Tuesday that were a bit troubling, but in general, the underlying inflation pressures are receding. Now, the implications could be positive for the economy if inflation pressures do continue to recede. One of the big headwinds that the economy is facing right now is declining real wages. Now, while wages are growing pretty rapidly, they're falling when you net out inflation. But note that the trend in real wages is improving. If we can get this back into a positive zone, that should really help consumer spending on a go-forward basis. Now, one of the things we've noticed as gas prices have fallen and real wages are beginning to show some signs of improvement is confidence has begun to hook higher. What we're showing here is the University of Michigan Consumer Confidence Poll in the top clip in blue. As recently as 2 months ago, it was hitting near record consumer pessimism. But in recent months, it's begun to hook higher. We're data geeks, so we're going to dive into the minute details of every economic report. But consumers are actually pretty simple. If their spending power is going up, they're confident. If it's eroding, they're not. Now, consistent with an upturn in consumer confidence, the economic trajectory has been showing some signs of improvement for Q3. After negative inflation-adjusted economic growth in the first half of the year, the Atlanta Fed is now tracking a positive real growth rate for Q3. The fact that inflation is running north of 8% means that nominal economic growth may be running at about a 10% level. That's actually pretty impressive. And if we can continue to make some progress on inflation, real economic growth may normalize. So let's talk earnings for a moment. One of the biggest fears out there is that, yes, valuations have come down a lot, but earnings are likely to contract. But that is just not supported by the data. This is another very robust model from our friends at Ned Davis that tries to determine whether the environment is bullish, neutral, or bearish for corporate earnings. For now, the environment remains bullish. And by the way, the consumer inflation report was on Tuesday, but that was followed on Wednesday by a report on producer prices. And that showed quite a bit less pressure on input costs. And that's likely to help companies preserve margins. We found that when consumer price index is running hotter than the producer price index, that has been a big bullish tailwind to corporate earnings. Now, we do have a potential headwind to earnings next year in the form of the Inflation Reduction Act. Earnings are projected to grow about 10% in 2023, and if they did, the 15% minimum tax would subtract about 1.4% from that growth. The drag would be greater if earnings growth is stronger, and it would be weaker if earnings growth has softened. So there is a potential headwind out there for earnings, albeit not a massive one. Now, other than just the earnings model that we featured a few slides ago, we can also look to nominal growth as a pretty good forecast for earnings. Earnings tend to track economic growth before inflation. And that's important. We need to remember that earnings are reported in nominal terms. And remember, I said that the economy is probably growing around 10% nominal. So if we can manage to continue positive nominal growth, then earnings could continue to grow as well. Now, moving on to some trends around the international markets, many of our questions lately have come around those international markets and the geopolitical risks that surround them. Now, we've had a very long time framework at Signature FD that is inclusive of international market investing. But international has struggled for the past decade compared to the US. Now, the main driver of that trend has been the US tech sector dominance. But when framing out the next 10 years, valuation is one of the best tools we have. And on that score, international markets are cheap relative to the US. This chart shows the discount based on price to earnings ratio for international markets relative to the US. International appears quite compellingly valued. And as investors, we need to remember that there's really only three things that matter. Those are your starting valuation, the value added while you're holding on to the investment, and then your ending valuation. And there's only one of those things that we can know for sure today, and that's our starting valuation. But speaking of interim value creation, we do also know that the current cash flows from international stocks are more compelling. Now, this does not speak to the potential for earnings, and we'll get to that in a second, but the dividend is a full 1.8 percentage points higher for international markets when compared to the US market. Now, from an earnings growth perspective, all we can do is look at forecasts. And on that note, forecasted earnings in the next 2 years are pretty similar for the US and international markets. And that's particularly true of emerging markets where earnings are expected to pick up meaningfully. Now, I'll bet that most folks wouldn't believe this, but international stocks have actually performed much better than US stocks this year. Now, of course, that's before one adds in the effect of the dollar. And what we're showing here in light blue is international stocks in their own local currencies. So just the pure stock price moves. For comparison, the US is shown in purple. Any underperformance from international markets in 2022 is more than explained by currency differentials. So what's the outlook for the dollar? Well, that seems to be pretty important here. Like most assets, we can apply a valuation framework to help understand the potential trajectory over the next 10 years. And that's what we're showing here is the value of the euro relative to the dollar in dark green. This looks similar for nearly any major currency relative to the dollar that we track. In the light green color, we show the experienced 10-year returns for the euro relative to the dollar. Now note that the euro was overvalued 10 years ago, and the subsequent performance has been weak. But now the dollar is extremely overvalued and relative to the euro and most other currencies. So we might expect poor performance for the greenback over the next 10 years. Now, we certainly understand that Europe and other international markets have major challenges. Energy is certainly top of the list right now. But on that note, something that has been encouraging has been that they have generally been able to fill up their energy stores for 2022. In the future, we suspect that there will be innovative solutions and new trading lines as it pertains to energy, but this is encouraging for the winter prospects. And that's what we're showing here. The dark green line in the top is plotting natural gas inventory relative to historic averages. And we can see that it's plotting well on top of average inventory builds. Now, filling their energy storage has certainly not come without a price. They've basically been a buyer at any cost, which has pushed natural gas up to clearly obscene levels. But the futures markets are anticipating that Europe will not have to be a buyer at any price next year and in subsequent years from there. Natural gas futures contracts are quite a bit lower for the future. Now, we just want to leave clients with this thought for the month before we get to some potential questions. We start every day with this question: what is priced in? It's important because there's always a crisis going on somewhere around the globe, or in the US economy, or even locally. For currencies, investors are hugely pessimistic on everything but the dollar. That's what this chart is showing, is pessimism on the euro, pound, and the Swiss franc. Other currencies look similar to this. For the broad markets, hedge funds have built record short positions. Money managers are the most overweight cash that they've been in a decade. Today, we wanted to present some data that suggests that much of what can go wrong is maybe already baked into prices. That doesn't mean we don't have concerns either. We do. But when consensus is one-sided, it often pays to lean against it. So to recap, the market has tracked prior midterm election years quite well. Headwinds should soon begin to clear from a seasonal perspective. And the two most likely outcomes in November have resulted in a bullish mix for stocks and other assets. Now, Q3 is looking like we may return to positive real growth in the economy, and progress on inflation, it has been frustrating, but generally it is moving in the right direction. If real wages can turn higher, the economic outlook will likely improve. Now, if earnings hang in there, we think the domestic stock market is pretty fairly valued, and international markets are potentially undervalued. Structural weakness in the dollar could benefit international markets over the next decade. So with that, I'll stop and see if we have any questions. Okay, looks like we have a couple. So one, this is a really great question, is can we really have a bull market in stocks if the Fed is still hiking interest rates? And that is a good question. And actually, some of our research partners have done some work on that recently. And in short, it'd be tough, but not unprecedented for that to happen. Typically, bears don't end until a rate hiking cycle stops. But also bears don't begin until after several months of tightening has already been going on. This has been a very odd cycle in that it's been one of the most anticipatory cycles that we've ever seen. The market has really been a few steps ahead of the Fed the whole way through here. So, the drop that we've had thus far, that's in line with the average tightening cycle. What we've seen is that the market has really been moving in much the same way that it has in previous aggressive rate tightening cycles. And I think that actually kind of brings up a risk, that there is a risk that the Fed does find a place to downshift at the end of this year, early next year, and slow down on their rate tightening cycle. And the market has done substantially better when the Fed is tightening slowly versus aggressively. So we wouldn't lean on actual rate cuts to make a bull call, especially because markets in this cycle have front ran the Fed so much in advance. Okay, another one was kind of around that inflation report earlier this week. Another good one. The headlines were certainly, around hot inflation and what have you. It's kind of, can we reconcile that with my comments that I've been making that inflation's improving? That's another good question. So yes, inflation came in higher than what was predicted for August, but that doesn't mean it didn't improve. It did improve. It was just expected to improve more. We saw the headline inflation rate continue to fall from its earlier peak. Core inflation, which strips out food and energy, that was a little more problematic. So that was kind of the comment that I made, that there was some trouble in the inflation report. The core inflation was mainly driven by rising shelter costs, especially in rents. Now, if you look at housing in general and its effect on inflation, housing tends to show up with a very large lag in the inflation numbers. So if we look at faster indicators of home prices and rents, they look much more disinflationary or even deflationary. Some of the stuff I'm seeing on rents is showing rents decelerating pretty fast here. And also, most leading indicators are showing some signs of improvement. So it takes a while to work inflation down from 9.1% to 2%. So we wouldn't expect 2% readings in the near future, but by next summer, it is conceivable that inflation's running at a more normal rate. So there is, and then again, there's also some major downside risk to inflation in the middle of next year if we do get the recessionary scenario. So another question that we've got here is around that cooling in the housing market. So that's a great segue, and in impacting the likelihood and the severity of a recession. And I think that is an excellent question. The housing market is definitely cooling. Everything that we see from a leading indicator perspective is the affordability issues have basically brought housing to a bit of a stop here. And that does have an impact in terms of driving recession. I think in our last webcast, we actually made reference to how housing tends to lead retail sales. So when housing is under stress, retail sales actually tend to follow. So that makes housing a very good leading indicator of the economy. I do think that one of the things that you're seeing is, and yes, if house prices collapse or anything like that, then yes, I think that could result in a more aggressive recessionary scenario. But when we stop and think about the supply and demand in the residential housing market right now, we are still well undersupplied in that market, hugely undersupplied in that market. So if anything, the drop in inventory that we've seen kind of a buyer's strike on houses. The drop in inventories that we've seen thus far should actually help set a floor under prices for housing, because it just kind of exacerbates the supply issue that we have in the housing market. So really good question. I think the housing market is something that we need to be paying attention to here as we roll into 2023. Okay, guys, that is all I'm seeing this month for questions. I very much appreciate the attendance today. Again, thank you for three good years of these webcasts so far. And I'll wish you all a great rest of the week and weekend. Thank you so much.